Have you ever wondered what that three-digit number is that seems to follow you around whenever you apply for a loan, rent an apartment, or even get a cell phone plan? That number is your credit score, and it plays a huge role in your financial life. Let's break down exactly what it is, why it matters, and how it's calculated. Simply put, a credit score is a three-digit number that lenders use to assess your creditworthiness, basically, how likely you are to repay borrowed money. It's a snapshot of your credit history designed to predict your future behavior. The higher the score, the more trustworthy you appear to lenders. Now you might be thinking, why do lenders even care? Well, lending money always involves risk. Lenders want to minimize that risk. A good credit score tells them you've consistently managed debt responsibly in the past, making you a safer bet. In the US, there are two main credit scoring models, FICO and VantageScore. They're similar but not identical. Let's start with FICO. FICO stands for Fair Isaac Corporation, the company that developed the model. It's the most widely used scoring model by lenders, accounting for around 90% of credit decisions. FICO scores typically range from 300 to 850, with higher scores being better. A score of 700 or above is generally considered good, and 750 plus is excellent. VantageScore is a newer model, created by the three major credit bureaus, Experian, Equifax, and TransUnion, as an alternative to FICO. It also ranges from 300 to 850, but the scoring algorithm differs slightly. While its adoption has been growing, it's still less prevalent than FICO. So, what goes into calculating these scores? Let's look at the key factors, focusing primarily on FICO since it's the most widely used. First, payment history. This is the biggest factor, accounting for around 35% of your score. It's all about whether you pay your bills on time. Late payments, even just one, can significantly ding your score. A history of consistent, on-time payments will build a strong score. Next is amounts owed, around 30% of your score. This isn't just about how much you owe, but how much of your available credit you're using. This is known as your credit utilization ratio. Ideally, you want to keep your credit utilization below 30%, and even better, below 10%. For example, if you have a credit card with a $1,000 limit, try to keep your balance below $300 or even $100. The length of your credit history accounts for about 15% of your score. A longer credit history generally leads to a higher score, as it gives lenders more data to assess your behavior. This doesn't mean you need to be old. It just means that the longer you responsibly manage credit, the better. Credit mix. This makes up about 10% of your score. It refers to the variety of credit accounts you have, such as credit cards, installment loans, like car loans or student loans, and mortgages. Having a mix of credit types can demonstrate your ability to manage different types of debt. Finally, new credit, about 10% of your score. Opening many new credit accounts in a short period can lower your score. Lenders may see this as a sign that you're desperate for credit or that you're a higher-risk borrower. Let's look at a simple example. Imagine two people, Sarah and David. Sarah has a credit card with a $5,000 limit and consistently pays her balance in full and on time. She's had the card for 5 years and has a few other responsible loans. David, on the other hand, has a credit card with a $2,000 limit, often carries a balance close to the limit, and has made a few late payments. Sarah is likely to have a significantly higher credit score than David. So why is your credit score so important? As mentioned earlier, it impacts your ability to get approved for loans, credit cards, and even rent an apartment. But it also affects the interest rates you'll pay. A higher credit score typically means lower interest rates, saving you money over the life of the loan. It can even affect things like insurance premiums and your ability to get approved for a cell phone plan. Now, what if you have no credit history at all? This is common for young people just starting out. You're not penalized for having no credit, but it can make it difficult to get approved for credit. You can start building credit by becoming an authorized user on a responsible family member's credit card, or by getting a secured credit card, which requires a cash deposit as collateral. Checking your credit score is important, and you're entitled to a free credit report from each of the 3 major credit bureaus once a year through annualcreditreport.com. Regularly reviewing your credit report can help you identify any errors or fraudulent activity. In summary, your credit score is a crucial component of your financial life. It's a 3-digit number that lenders use to assess your creditworthiness. It's based on factors like payment history, amounts owed, length of credit history, credit mix, and new credit. Maintaining a good credit score can save you money and open doors to financial opportunities. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.